South African real estate investment trust sector is poised for growth in 2025. This despite the economy's prolonged stagnation in 2024 and on the back of improving investor sentiment and property fundamentals. The SA REIT Association says with the economic recovery, lower interest rates and robust demand for commercial property, the sector is poised for growth this year. The association's research committee chairperson Itumeleng Mothibeli joins us with more insight. Thank you so much for your time, Itumeleng. Now, how would you characterize the recovery of the property sector in South Africa for the last 4 years? Because, I mean, I guess it's still our reference point has to be from COVID and beyond.
Yeah. Good evening, Renati. Lovely to be on the show with you. I think from our side, we're really encouraged to see the steady improvement that we've seen over the past 4 years. Like you said, 4 years ago, 5 years ago, we had challenges of COVID. Over and above that, we had riots in KZN. We've had flooding, high interest rates and flood environment, services on the ground under severe pressure. But notwithstanding all of that, if you look at our members, trade is now tracking slightly above inflation, which is phenomenally encouraging. And I guess, if the top line is doing well, NOI increases, valuation growth comes through in the sector, and overall the sector continues to perform positively. In characterizing it, I would think, Zanati, there'd be three key drivers from our point of view.
Yeah.
I think the first one is, kind of this whole idea of improving health of the consumer. So if the consumer improves, the demand also improves. So we're really encouraged by employment absorption, retail sales improving over the past quarter, credit extension, and those types of measures. And I think the second one, what we've noticed over the past 4 or 5 years, a really challenging environment. We've seen slowing in supply of new stock on the ground. And what that then does is the incumbents that have assets can get all the demand. So what we've seen is an environment of what I would say A-grade assets, really getting strong demand and vacancies being at record lows. And then the challenged assets, what I would term C-grade assets, we're finding operators on the ground that are nimble, that are changing uses from, let's say, offices to resi, to student accommodation. So all of that type of stuff is really augured well for a strong performance of the sector. Yeah. And then the last point, I think, Zanati, is, the sector has been really, at the forefront of driving solar PV and alternative energy. And I think all of the PV plants that you see in all of these shopping centers, the majority of our members generally have, between 5 and 10% of all of their energy needs now being fed through by PV. So if you combine all of that together, that's how we've seen, the bottom line of these REITs grow over a very challenging environment.
Yeah. Well, I mean, just talking about a challenging environment, we're all challenged by higher interest rates, really just drilling into the impact then of the changing macroeconomic landscape. It was anticipated for interest rate reductions to actually trigger softer economic conditions and growth within the property sector. But how much aid can be provided by a more shallow interest rate cutting cycle?
Yeah, and that time we coming into the year, we're really optimistic that on the back of the 75 basis points, we see a lot more. But I think in the reality with the pressure coming through from the US and the Fed pausing, that it will be shallow. And it's a significant issue in the real estate sector. There's a direct relationship between interest rates and our values. In fact, at the listed sector, the higher the interest rates, the lower the values. So what we saw towards the tail end of last year with the drop in interest rate, we saw property prices increasing. And coming out of COVID, a lot of the property counters were trading at slight discounts to NAV. So that NAV gap was closing. And that's important for REITs because once you start trading at NAV, you can raise capital that is not necessarily expensive. Yeah. And in raising capital, you can build your business, open-ended funds, and that's how you grow, a REIT. So it's a significant issue, the slowing of the interest rate for our listed counters. But also, I think, operationally on the ground, on the direct side, the viability of schemes. You look at the building costs where they are at the moment, and you look at the rental that we're currently getting, big lever is managing that cost of capital. So if you can decrease your cost of capital, your schemes are then a lot more viable. So this issue of interest rate, really impacts our sector. And we're really hoping that, we can get at least the 25 basis points that is forecast for this year.
I'm also just interested in what your tenants are looking for at the moment, with the kind of economic conditions that we are under. Are there any emerging trends that are shaping tenant demand decisions, changing tenant needs that landlords need to cater for?
Yeah. So that, I think that's a big theme that we're monitoring across the sector. I think one of the key things that we're thinking about now is this idea of the end user, as being the most important stakeholder. And consumer needs are changing drastically. A case in point is when you walk inside a shopping center, you have never seen so many motor bicycles, and that's because of the Checker 60 delivery mode.
Yeah.
So that changes. That change in consumer behavior impacts how you look at your tenant, how you look at your tenant mix, and it requires landlords to be nimble. So to me, I think the point of departure is really understanding the consumer and trying to find solutions jointly with the tenants that speak to the changing tenant needs. In the office space, a lot of people still aren't back, in the office industry. So we need to think about, how we can repurpose space so that it invites people into, a holistic lifestyle type of setup, where you can draw people to a precinct, with the office as well. And then on the logistics front, we're really seeing a lot more high-tech industrial emerge in strong functioning nodes that are close to arterial and main roads for transportation. So I think all of those changing demands from the end user, which is the consumer, is something that we need to think about, and we need to be nimble, and we need to have a partnership mindset, with all of our tenants, try and solve for this changing environment that we're in.
You seem very, very optimistic. And just to close off the conversation, just looking at the growth trajectory of South Africa's economy, is there any encouragement that economic conditions could trigger structural growth in the property sector in the medium term?
Yeah. We are encouraged. We came into this year listening to a lot of economists' briefing with the most upbeat start of the year that we've had in a long time. The macros are looking positive, the consumers looking healthy, retail sales are moving in the right direction.
Yeah.
Our GDP forecast is looking strong. So I think all of these building blocks really augur well for the growth of property, because ultimately, the more demand that we get from consumers, the more we can supply, the more tenants we can attract, and more growth we can have in terms of our NAV and our holdings. So what we're seeing now leaves us, very encouraged that looking ahead into the next 18 to 24 months, that the sector should continue to show growth. Our income side is looking strong, growing at faster than inflation. It's managing the capital growth side, and so that we can deliver a very strong total return for our investors.
All right. Well, thank you so much for your time and just really giving us more detail on the property landscape in South Africa. That was Itumeleng Mothibeli, Chairperson of the SA REIT Association Research Committee.